The loonie surges as Canada falls, scrapping its digital tax to appease Trump and rescue trade talks. Ottawa now aims for a July 21st deal, sidestepping the July 9th crunch faced by other countries. Live from Singapore, this is Insight with Haslinda Amin, where we dive deeper into the stories that matter with crucial context and sharp analysis. Asian stocks rising along with U.S. futures as progress is also made in several other trade negotiations, boosting risk appetite. However, with just 10 days to go until elevated tariffs are set to resume, the White House looks set to fall short of the sweeping global trade reforms it promised to achieve. Meanwhile, China's factory activity improves for a second month as trade rebounds after the tariff war truce with the U.S., but weak consumption is still weighing on the economy. You're with Insight. It is a big week for markets as they enter the third quarter with the July 9th deadline for President Trump's so-called reciprocal tariffs fast approaching. Investors are hedging their bets with global stocks well off April lows and Treasuries setting up for more gains after a 3-week winning streak. Avril Hong is here. And Avril, how are markets setting up for the third quarter? We know it is in a good place, but it is time to be wary as well.
Yeah, there are reasons to be cautious. We have Asia stocks in the green today, outperformance in Japan after trade negotiations extended. But you also get the sense that even if we see trade deals, they're not likely to resolve some of these longer standing issues. These tariff uncertainties in the first half, along with some of these geopolitical flare-ups and a Moody's downgrade, it's remarkable how U.S. bond markets are notching profits for the first half of the year. Those reasons to be cautious include curve steepening. Of course, part of the conversation, along with that U.S. Senate debate on Trump's $4.5 trillion tax cut bill this week. And that is something that could also play out when it comes to other G10s, including Japan, where we have key auctions set for this week, 10 and 30 years. The finance ministry has reduced issuance for long end, but that doesn't seem to be helping improve appetite for long-end JGBs. Take a look at what we're seeing the rest of the week as well when it comes to key events to watch out for. They include an annual forum of the ECB underway in Sintra, Portugal, and we're set to see from the likes of Lagarde, Powell, Ueda, some commentary there, the discussion surrounding curve steepening, but also central bank independence, and of course later in the week the US jobs report as well, and that's coming a day earlier than usual because of Independence Day. Might the data feed into the case for the Fed to pull the trigger a bit earlier when it comes to more rate cuts? And that could be another catalyst when it comes to Treasuries. As you said, 3-week winning streak. Now, flip the board. I also wanted to talk you through what we're seeing in China data. We had modest beats, whether you're talking about factory or non-manufacturing data. The factory activity declines managed to ease. So all in, seen as a boost of sorts for Chinese stocks. But longer term, I think what investors still want to see, better data, better earnings, and better progress when it comes to trade talks.
And of course, that remains to be seen. Avril Hong, thank you so much for that. Now it's just 10 days until President Trump's so-called reciprocal country-specific tariffs are set to return to high rates unless deals are struck. And the White House looks to be poised to fall short of the sweeping global trade reforms it promised. For more on where we stand, let's bring in our Chief North Asia correspondent, Stephen Angle in Hong Kong. And Steve, the U.S. and Canada are set to resume talks after Ottawa backed off on a digital services tax. What do we know so far?
Yeah, that's right. So this is probably just what we're likely to see over the next 10 days. A lot of volatility and a lot of changes of the news flow, depending on how these negotiations and how deep these negotiations go with the United States to possibly mitigate against a resumption, of course, of those unilateral reciprocal tariffs on the host of nations. Keep in mind, it was Peter Navarro who said back in April that that 90-day pause would likely net about 90 trade deals. Well, we have 2 so far, and they probably, if you look at it on merit we'd probably say that they, as you rightfully said, Haslinda, probably fell short of the ultimate goal that the United States had, especially on China, in the sense that it's a framework agreement and the details will be meshed out over further negotiations and lower level discussions. I'll get to China in just a second. This move by Canada just within the last couple of hours, saying they will scrap this digital services tax, which was passed last year and then was due to come into effect, and was something that the Trump administration targeted and cited as the reason for cutting off negotiations with Canada. Now Canada is saying, okay, we are going to rescind that digital services tax. We will continue negotiations with the United States with the aim, perhaps, of reaching some sort of deal with its largest trading partner across the border by July 21st. Now, July 9th is that deadline for all these other countries. And we're hearing that India, because they had a negotiating team in Washington last week, is making progress. Other countries like South Korea, Vietnam, and a few others, including even there was optimism over the EU, starting to make some progress. But it's going to be a very truncated and short and intense next 10 days.
That's right. 18 key trading partners in negotiations. And Steve, when it comes to China, we know that China has said no trade deal at its expense. What's the latest here?
Well, that is the latest because, again, we did get the Ministry of Commerce essentially on Friday confirming what Howard Lutnick had said, that the trade deal had pretty much been signed, a framework deal, essentially recommitting to what they had discussed first in Geneva and then in London, and coming up with an outline that China would essentially not necessarily fast track, but expedite the licensing agreements for the export of rare earths and rare earth magnets, which the United States has demanded. And then the Chinese Ministry of Commerce has also confirmed that China then would in turn, or the United States would in turn relax some of the more recent export controls. But again, the devil will be in the details on just how fast these moves will go and who moves first, and will one follow the other. So no nation wants to follow the other one. It needs to happen in lockstep. So there are lots of landmines potentially to derail this. And what the Ministry of Commerce came out with a fairly sharply worded comment on Saturday after that confirmation the day before, and I'll just read it verbatim. The U.S. side, China firmly opposes any country reaching trade agreements with the U.S. that would sacrifice Chinese interests in exchange for tariff relief, and that there would be countermeasures if that were to happen. What that is telling the rest of the world, as you enter trade negotiations with the United States, do not throw your trade relations with China under the bus in order to get a deal with the United States. There will be consequences for that. And there's no surprise, no coincidence that Wang Yi, China's top diplomat, heads to Europe today. He'll spend 7 days meeting European leaders to sort of set the table for the EU-China summit that is going to be happening in Beijing later in July.
It is about expediting rare earth exports from China, isn't that the key thing, Steve?
Yeah, not just for the United States, but for the European Union as well. They want those rare earth magnets. And it's about, I mean, it's obvious that China has used this as leverage in any kind of negotiation. Clearly, the United States and the tech supply chain needs these batteries. It needs the rare earths. Europe and its manufacturing girth also needs that. So it's become a big sticking point.
Stephen Angle, we thank you so much for your time today. Bloomberg's Chief North Asia correspondent Stephen Angle in Hong Kong. So the trade truce with the U.S. helping improve China's factory activity for a second month, but the official PMI is still in contraction and consumption too remains weak. Let's get perspective from Raymond Yeung, Chief Greater China Economist at ANZ. Raymond, your take on the numbers we saw today?
It's still contraction, it's below 50, but of course it's a slight improvement from the previous 2 months. And at least that we don't see any collapse of China exports. New export orders seems to hold up. And the trade deal seems to be underway, and at least they agree on the framework agreement. So I do believe that the second quarter GDP will have some upside risk from our previous expectation of within the range of 4.5% to 5% growth for the second quarter. And now that with this PMI number, it seems to be at least closer to 5% range, and that seems to be a positive number from today's PMI release.
Isn't it true, though, Raymond, that domestic demand remains weak? There seems to be a need for stimulus. And we heard from Li Qiang at the World Economic Forum last week that there is urgency to implement stimulus measures. Are we expecting that at all?
I think there's a puzzle, for the authorities right now, or at least a question to ask is whether they pay attention to the GDP number, which seems to be okay, from the output index today and the industrial production this month. But at the same time, I do see that the joblessness or the job or employment index of today's PMI survey remains very weak. So the problem of China is not about growth. It's about deflation. It's about the jobless situation. They should pay attention to these economic figures rather than GDP growth or output. So I think from the policymakers that they might still want to prefer using fiscal policy as opposed to monetary policy, because they know that by keep printing money doesn't really help. In the end, that the banking system will just put the funds into bond purchase, but rather than going to the real economy.
So realistically, what can we expect in terms of stimulus for the next, 6 to 12 months, given that China's industrial farms have reported, the slowest profit since October? So obviously, they need some help.
I think from now to the end of August, the authority will be very disciplined, and they're not going to have a massive stimulus or massive monetary policy. They will be doing the fiscal policy as scheduled. And the program announced that a couple of months ago, during the NTC, bond issuance and consumption support, and make sure that the local authorities and SOE follow the mandate. I think this is what they will be focused on. Is more about the execution rather than the strategy change. But then after the July Politburo, if they hold it, so far we have not seen the May Politburo, and even the June Politburo has not held a meeting. So if they have the July meetings, typically they will use it to assess the second half economic condition and decide on whether they need to boost the stimulus and increase the scale of the stimulus. By then, that might be having more aggressive monetary policy if China cannot address the deflation problem, which is our base scenario that we'll still continue to see the deflation, and the property market will continue to be very, very sluggish. That require a bolder move of monetary policy easing.
China's manufacturing, of course, is key to its growth story. We know that it's shown resilience. What's the outlook for the rest of the year, given that it has managed to diversify, its manufacturers and its exports, despite the tensions between the U.S. and China?
I do think that the domestic market is more important than the foreign market. By our estimation, still 90% of the Chinese economy is domestic. It's only 10 to 12% related to export, and the export to the U.S. actually contribute to 3% of the GDP. It's very, very small, but of course that dominates the market discussion right now. So for China to address the overcapacity issue and the overproduction issue and a lot of inventory on hand, they do need to to lift the domestic market momentum and domestic demand, which is more to do with the property cycle. And our base scenario remains to have at least 2 years of adjustment for the local property. Now, for the export market, of course, we saw the export to ASEAN and export to Europe holds up very, pretty good, to offset the decline in the direct shipment to the US. So I'm not worried about the export side for the rest of the year. I'm more worried about whether the authority have the determination to address the property and asset price deflation domestically.
The thing is, overseas demand accounted for about, 40% of growth in the first quarter. Can that pace be sustained in the coming quarters?
I think that's only at the margin. If we look at the expenditure approach and look at this net export contribution to the GDP is not really what drives the Chinese economy. So I do think, of course, that now seems to me that the trade talks with the U.S. goes very well. So I'm not worried about the external demand. So I think that the export will still be having a few percentage point increase this year overall, second half, and if the tax supply chain activities can sustain, also you have something to do with Chinese export of rare earth too. So that will be helping, the export side of China.
Raymond, what assumptions are you making about the yuan in the coming quarters against a backdrop of a dollar that is normalizing and is weakening from here?
The last few months, since the tariff announcement of Liberation Day, that the behavior of US dollar is very interesting. It's not following the conventional wisdom. So I think that the yuan or the CNY rates have more to do with what the dollar behave in the second half rather than China itself. From the policy perspective, the Chinese authority has already demonstrated their ability to manage the dollar CNY move. It seems to us that the second half will still be pretty stable with a slight upside or strengthening bias as well. As long as we see the dollar weakness, then I don't see the risk of massive depreciation. And at least from the policy point of view, China is not going for competitive devaluation. So I do think that the renminbi exchange rate will be stable with a slight strengthening bias in the second half of the year.
We've seen volatility in the USD. Assumptions made much earlier have not quite materialized. How might this play out in terms of the movements in the yuan?
Now, of course, that the yuan is clearly be managed by the authorities, and the capital outflow from onshore to offshore is not that big, and even if this flow to the offshore is more to do to the Hong Kong market, and is still under largely controlled, by the policymakers. So I'm not worried about the strong capital outflow. The price itself, the pricing of the dollar CNY is more to do with the dollar, in the global market. And the last few months we saw that the DXY, has been pretty low because of strengthening of euro. So as long as the Chinese policymaker, they see that the renminbi exchange rate is not too far from the behavior of euro, then they will be okay in terms of how they manage the fixing every day and how they track the spot and volatility of the dollar yuan. The financial stability is always number one priority from Beijing. So they will keep an eye on any massive move of the exchange rate, and they definitely more than willing to act if there is any strange movement or hurt behavior from their point of view of whether the markets remains keep in order. I think this is how the Beijing managing the renminbi exchange rate in the rest of the year.
Raymond, thank you so much for that. Raymond Yeung, Chief Economist, Greater China at ANZ. Well, still ahead, the Thai Prime Minister's poll numbers tumble into single digits as protesters rally demanding she step down. The latest from Bangkok next. Keep it here with us. This is Bloomberg. Welcome back to Insight. Thai assets have been under tremendous pressure as investors weigh in on the political turmoil in Thailand. Now, the SET down 22% this year, among the worst performers in the world, and the Thai baht has surged about 5% this year, approaching its highest level since 2022 against the US dollar. Of course, we heard from the BOT saying that it will step in if it sees that the Thai moves are unhinged. Well, support for Thai Prime Minister Paetongtarn Shinawatra has slumped to single digits in a new opinion poll as the leadership faces being engulfed by a diplomatic scandal. Bangkok Bureau reporter Patpichai Tanaka Sempipat joins us now for more. Best, I mean, how significant has the protest been?
Sure, Haslinda. The Prime Minister's dramatic decline in popularity coincided with the massive protest of more than 20,000 people that gathered in Bangkok on Saturday to call for her resignation, saying that she had betrayed the country in a phone call with former Cambodian Prime Minister Hun Sen that was leaked earlier this month. The protest had the biggest turnout in years and quite significantly raised the political temperature on the ground in Bangkok, with the government still very much on the brink of collapse and not really doing much to address this growing public frustration. And I have to say that a lot of the anger also had to do with the government's handling of a broader land dispute with Cambodia, which is why we saw the Thai national flag being waved around everywhere at the protest scene. And for this reason, as you know, nationalist sentiments are involved, there's a lot of potential for this protest to escalate, as the protest leaders are set to meet later this week to decide on having a second rally to further increase the pressure on the government and the Prime Minister to step down.
Are people concerned about a possible military coup?
Definitely, Haslinda. The protest on Saturday was an all too familiar scene for many observers of Thai politics because it shows the convergence of many groups that had earlier protested against Shinawatra governments in the past. And a lot of the protesters on Saturday had rallied against Paetongtarn's father, Thaksin, and aunt Yingluck Shinawatra, with those protests ending in military coups in 2006 and 2014. And for this reason, the political deja vu is again putting the prospect of yet another military coup on people's mind. The opposition People's Party has urged people to withdraw support from this movement and said that if it spirals out of control, then it could set a very dangerous pretext for another military intervention. Although so far, the army chief has said that the army is still committed to democratic principles, which suggests that it will not yet intervene at this time, though the statement has done very little to ease the concerns on people's mind.
What have we heard from Cambodia's former Prime Minister Hun Sen?
Hun Sen has made it very clear that for Thailand and Cambodia to resolve this border dispute that started in May, there needs to be a leadership change within Thailand. And he has taken to social media to repeatedly criticize Thailand's decision to restrict border movements between the two countries and lay the blame completely on Paetongtarn for her handling of the situation. And you know, Hun Sen may actually get his wishes, as we have to see how the challenges against Paetongtarn plays out. Some key watch points now are the escalation of protests that are calling for her resignation, as well as a barrage of legal petitions that have already been launched against her, saying that she had violated ethical standards, which, you know, could be grounds for disqualification and could see her removed from office. You know, the Constitutional Court is set to meet later this week and could consider one of those petitions as early as this week, and its decision whether to take on the case will have huge implications on the survival of the Prime Minister as well as the performance of the Thai markets.
It does feel like we have been here many times before. Bangkok Bureau reporter Patpichai Tanaka Sempipat, thank you so much for that. Still to come, the US and India closing in on a trade deal ahead of President Trump's July 9th deadline. We'll dig deeper into the talks with the Indus Tech Council. Keep it here with us. This is Bloomberg. Welcome back. You're watching Inside. India's trade negotiators extended their stay in Washington by 1 day as they work to nail down a trade deal with the White House ahead of President Trump's July 9th deadline. Let's get the latest on what's still to be resolved and bring in our India trade and economy reporter, Kriti Upadhyaya. Kriti, well, we're close to the finishing line, but not there yet.
Yes, absolutely. So we just have 9 days to go until Trump's reciprocal tariffs kick in, and the two sides, the US and India, have intensified their negotiations for securing an interim trade deal. Now, the Indian negotiating team, which was supposed to stay in Washington for 2 days to resolve the differences, they extended their stay in the hope of resolving and ironing out differences between the two nations as they race to, meet the deadline for an interim trade deal. But let's keep in mind that the two sides, we still don't see much resolution. While we don't have many details, we know that Americans are wrangling over, wider market access for their genetically modified crops in India. And Indian side has dug in its heel. It wants its concerns on reciprocal tariffs and sectoral tariffs to be taken care of. So we need to see how the discussions pan out over the next 2-3 days before July 9 deadline.
Might talks still fail, Kriti?
I think, Haslinda, it's too early to say whether the talks may fail because both the sides have been at it. They have been trying to iron out differences. They have been holding regular meetings. So I think it's too premature right now. But I can say for sure that I think we would need, greater momentum now in the talks if the two sides wish to meet the July 9 deadline.
Kriti, thank you so much for that. Bloomberg's India trade and economy reporter, Kriti Upadhyaya. Now let's get perspective. Kriti Upadhyaya, founder at Indo's Tech Council, a Washington and New Delhi-based organization, is focused on accelerating tech collaboration and innovation. Kriti, good to have you with us. This US-India deal was supposed to be one of the first wins for both sides, yet here we are struggling to get to the finish line. What's your take on why it's been so challenging?
Well, thanks for having me here. I think the US-India trade deal was never supposed to be an FTA, right? It was supposed to be a bit-by-bit, or rather tranche-by-tranche deal. July 9th, we're anticipating the first tranche of this. And I think there's good momentum. I think we've already tackled some very contentious issues within this trade deal itself. Pharma, we're hearing, be it generics, India's access to generics, or US wanting more price transparency, steel and energy, the Section 232 tariffs that India wanted some relief from, medical devices, which are very important for the US, and generally, on some really strategic sectors, be it energy, LNG, defense, and so on. So I know that we still have many issues like dairy and agriculture that the two sides are still going to keep going on back and forth with. But I'm positive and I'm hopeful that July 9th we'll still see a sort of a trade deal.
Truth of the matter is that this trade deal has been elusive from Trump's first administration. What's different this time round? Is there, greater appetite on the part of India to make more concessions?
Absolutely. In fact, what you've said, elusive, is exactly the word that we use here in Washington, D.C. We call it the elusive US-India trade deal. But let's not forget that we've had successes too. Under President Trump's first administration, we came very close to ironing out a trade deal, a sort of mini trade deal. And we're really building on that momentum in this administration as well. I think what's critical and what's changed, or rather, I wouldn't say changed, but has been underlined more, is the fact that this is something that's important for both sides. India needs this to sort of position itself as a global market, global player, to be taken very seriously as a global market and global player by reducing its tariffs and really giving access to some key sectors. And for US at this time, it's important because it really shows that the US is willing to work with partners and allies. And as you and I both know, all of this is happening in a sort of silent background of China, where both countries have large trade deficits with China. Both countries face similar challenges from that economy. So I think more than a trade deal, this exercise this time round is really a sort of trust-building exercise. The two countries going ladder by ladder, rung by rung, sort of tranche by tranche, right?
Right, and it is a huge deal. The fact of the matter remains that, the U.S. wants to open up India, it says. Might that actually impinge on India's own ambition as a manufacturing hub? And might that eventually impinge on its growth?
Well, if you look at India's tariffs, India has about 11% average weighted average tariffs, while the U.S. has something under 2%. So India does have high tariffs, and as you know, for a growing economy, that's now going from growing to growing more, lower tariffs, I think personally, will actually help India. That having been said, it's not just India that's asking. It's not just the U.S. that's asking for lower tariffs in India. India is also asking for lower tariffs in key sectors within the U.S., be it steel or be it some more labor-intensive sectors within India, which India likes to export to the U.S., be it textiles, gems, carpets, leather goods, garments, and so on. So I think it's not just the U.S. that's pushing for a reduction in tariffs; it's India that's pushing for a reduction in key sectors within the U.S. as well.
When we take a look at the tariffs, we're unsure where it's going to land, but as it stands, it's 37%. In comparison with some of the countries around the region in Asia, like China, Vietnam, they're being imposed with tariffs in excess of 37%, 34%, thereabouts. I'm just wondering, India remains attractive even at current rates in comparison to its neighbors, correct?
Yes, that's true. I think there is an understanding that China plus one is usually China, right? We see a lot of trade increases from countries within Southeast Asia, which is actually just Chinese dumping products, which are then being exported. So I think I believe that was maybe the understanding, and I'm actually supportive of that understanding, where they've actually tried to keep China plus one options much higher than India, which is a much more trusted economy.
There's a sense out there that in trade negotiations with the U.S. isn't willing to give a big score, a big victory to whichever country that it is negotiating with. Might both sides eventually lose in their trade negotiations if Trump's all stick and no carrot kind of approach plays out?
Well, we'll see how this evolves. I think President Trump has been sort of known as the deal man. Whatever his approach may be, I think we've seen that he has consistently delivered on certain significant deals, be it on the China trade deal that recently happened on critical minerals. Who was expecting that, right? Or the Abraham Accords, the more strategic deals. So I think there is, especially in the U.S.-India relationship, I think there is a way that we can have a sort of reciprocal win-win situation.
How are the Indians looking at it? Is there a sense that perhaps they're looking at India being bullied by a foreign country, a foreign leader?
I think India has been on a sort of rampage of getting trade deals. So, be the FTAs, actually FTAs, right? So India has done FTAs with a bunch of countries, be it in the Middle East, with the UK. So for the first time, India has actually in the past few years really changed its direction, where earlier doing trade deals was sort of seen as being cornered. Today, it's India who wants to go on the global stage and seek trade deals with countries, partners, and allies to sort of secure its own position within the global ecosystem.
You talked earlier about how this could be an opportunity for India to reform. What form might that take? What are you hoping to see?
Well, I think India has already done a lot of reforms in various sectors, be it sort of increasing the foreign direct investment caps across sectors, decriminalizing a bunch of rules and laws. So there's been a huge reform movement. I think reforms within trade could be sort of spurred by this trade deal or the sort of trade deals that India has been having with other countries. Because what India essentially is doing is that it's saying that, okay, we're not sort of going to hold on to the infant industry argument anymore, at least on certain other sectors where we're in a good footing, and start opening up. So I think that bodes well for India overall. Personally, I am a pro-trade, pro-economy. So I think this is going to be something that's going to bode well for India long term, even if there are certain, sort of issues, growing pains or growing issues in the short term.
Right. So you think that Indian economies, Indian sectors are ready to compete globally because initially the government has imposed protectionist policies, adopted protectionist policies to help them grow. And most of these sectors have matured and possibly ready to compete globally.
Many of them, yes. So I think it's time to open up those sectors. There'll be certain sectors that will require a little bit of protection, like agriculture or so on, or certain strategic sectors. But I think overall, India is now open to really working and collaborating on the global stage. Look, this is important for India too, right? Both US and India. In February, President Trump and Prime Minister Modi signed the Mission 500, the $500 billion in trade. And trade has been growing well. It's somewhere around $130 billion in bilateral trade right now. So I think this trade deal is going to be very, very critical for both the countries to reach that mark as well.
You're the founder of Indus Tech Council. I'm just wondering, how do you see both sides working together in the area of tech?
Yeah, so I work actually in defense tech, dual-use tech. We're seeing a lot of momentum in this one area for sure. Earlier there was a lot of stuff on defense tech was government to government led, or sort of between the big players, the primes as we call them. In the past 5 years, what we've really seen is a sort of democratization of defense tech or sort of business relations, right? You're seeing the smaller players, the startups, the tier 2, tier 3, the small and medium enterprises really coming in. So, where you're seeing companies like JSW Steel investing in the US, you're also seeing a lot of startups really moving within the United States. You're also seeing a lot of manufacturing now finally coming into India. India is sort of seen. I mean, I always say, right, if US has innovation, India has the scale. I think finally India is trying to deliver, or beginning to deliver on some of that scale across sectors.
So how might it look like in the next 5 years then?
Well, I wish I could tell you. I'm no soothsayer, but I'd say that sectors that I would watch out for, definitely energy, because, regardless of who's in power, there is a bipartisan support for energy security. Sure, you may have clean tech at certain points. Today, you have LNG, which is a major area for growth. Industrial goods. I think that's a sector to watch out for. Technology in general, defense, pharma. So I think 3 sectors, if I would lay down based on this trade deal or just US-India trade ties, that I would watch out for would be pharma, defense, and energy. And then also the more strategic areas like rare earths and critical minerals. And you'll see that a lot of the stuff that's happening in tariff reductions, you'll see the second and third order effects of them as well. You'll see a rise in exports. You'll see more supply chain resiliency. So I'm looking forward to all those things. Having said that, I am an eternal optimist.
Kriti, great insights. Kriti Upadhyaya, founder at Indus Tech Council. Thank you for that. Now, oil prices continue to weaken following their biggest weekly loss in more than 2 years. Hedge funds piled into bearish bets after the fragile truce between Iran and Israel and before a likely OPEC plus supply hike. Brent crude currently trading down by 0.2%. New York crude lower by 0.5%. Now, U.S. Energy Secretary Chris Wright says the administration's goal is to secure a lasting peace deal with Iran following the strikes on the country's nuclear sites. Speaking to Bloomberg, he added that Washington aims to promote commerce, not conflict, in the Middle East.
The sanctions are still in place. No change there. I think what President Trump was referring to there is, hey, if we make a large peace and sanctions come off, Iran can flourish.
Have you got a decent understanding, though, Mr. Secretary, of just how much Iranian crude is being consumed and imported already as things stand, despite the sanctions?
We do. So Iran produces about 3.5 million barrels a day, and they've been exporting about 1.5 million barrels of oil a day. And the maximum pressure campaign that President Trump did in his last term tamped that down to only 100 or 200,000 barrels a day. They cut off 90% of it. That was a possible strategy here as well, but hadn't been implemented yet. We tried to give negotiations a chance, see if we can do it without maximum pressure.
So is maximum pressure still on the table, or is the administration walking away from that?
Well, the goal right now, of course, is to get a peace deal, is to get peace into the Middle East and spread the focus on commerce, not conflict. So, no, it's not actively being discussed right now, but the situation's still dynamic there. We want to see peace, prosperity, and security as the future of the Middle East.
When it comes to what's going on in Iran as well, in terms of the IAEA, the foreign minister said yesterday that basically they have no plans to having the Director General, Rafael Grossi, in Iran. And it doesn't sound like they're willing to give the inspectors the space, time, and access they need to look at these nuclear facilities. What is the United States' response to that?
Yeah, look, this is early on. This is early on. Iran has just had most of its nuclear program entirely devastated by Israel and the United States. They're a little bit humbled. They're a little bit shell-shocked right now. So, yeah, I wouldn't put too much weight on those words, but a final peace deal certainly has to have confidence in a dismantlement of the Iranian nuclear program and that people can have security it won't be resurrected in the future.
You deal with a lot of nuclear at the Energy Department. Before the U.S. strikes, but after the Israeli strikes, Rafael Grossi told us that the IAEA cannot verify whether 400 kilograms of 60% enriched uranium in Isfahan was currently where it was. Was it still there? Did the Iranians take it out? Doesn't the IAEA need to go in and verify where this enriched uranium is?
I think that's quite likely part of a future negotiation or a future deal.
And that was U.S. Energy Secretary Chris Wright speaking to Bloomberg's Jonathan Farrow and Anne-Marie Jourdain. Well, still to come, we hear exclusively from Noetix Robotics after its humanoid bot was a big winner at the Beijing Marathon. More on the robotics race next. Keep it here with us. This is Bloomberg. Welcome back. You're watching Insight and a really painfully slow soccer game, but bear with the clumsy footwork as robotics tech in China continues to grow at a blistering pace. Now, these humanoid robots are still far from taking on Lionel Messi, but this game played in Beijing over the weekend was seen as a breakthrough for robot kind and artificial intelligence. And that's because their movements weren't remote controlled by anyone on the sidelines, but by built-in algorithms. And for the record, the winning team came from Tsinghua University. Meanwhile, Chinese startup Noetix has seen orders race ahead after its N2 humanoid robot took second place at the Beijing Marathon's robotics showcase in April. Founder Zhang Zizhuan spoke exclusively to Bloomberg about the company's growth and how it plans to navigate tensions between the U.S. and China.
The biggest change to our company is that we sold over 2,500 robots to our consumers after the race. The second biggest change is that a lot of media and investors are coming to our company to interview me or my team and to invest.
How much are you looking to raise right now?
We're looking to raise over 250 million Chinese yuan in the newest round of fundraising.
What valuation are you doing that at?
The newest round of raising of our company, we are valued at $200 million US.
Before the humanoid robot race took place, what was your valuation?
Before the marathon race, our company was valued at, in Chinese yuan, is 500 million Chinese yuan. It's like 70 million US dollars.
And so 2,500 robots essentially since the robot race. What does that mean for your annual production capacity, and is that changing?
This year we are building about 2,000 robots, and next year we plan to build over 10,000 robots. And we will be, we want to be the first company in the world to produce more than 10,000 robots.
So today Noetix robots are sold in China. When would you look to expand abroad, and where would you go to in particular?
We'll start our global sales in October or after. We target to sell our robots to North America and Europe and Middle East.
The products that you use, or the components in the humanoids, are they sourced from China, or do you also need to source products or components from other parts of the world?
Most of the parts of our robots are manufactured in China, but there are a few parts of the robots that are from global suppliers. Like we are using the STM32 chip in our joint motors and our communication boards. We are using Intel chips in the computer of our robots. And we are using Intel RealSense camera in our robots to see the surrounding environments. Besides these, most of our components are manufactured in China.
But on those products that you are using, and particularly from the US, do you have any contingency plans in place if the US were to further restrict China's access to technology?
Yes, like the STM32 chip, they can be replaced by GD32 that is manufactured in China. And we are now testing the Rockchip CPU to replace the Intel CPU in our product.
Do you see a scenario then where you're not using any technology from the US?
So I think we should embrace technologies from all parts of the world. We are thinking about the extreme situations, and we are having plan Bs for that situation.
That was Noetix Robotics founder Jiang Ziyuan speaking exclusively with Bloomberg Tech reporter Annabelle Drulers. Now, a quick programming note before we go. You can see live coverage of the massive monetary policy panel with Jerome Powell, Christine Lagarde, Kazuo Ueda, Andrew Bailey and Chang Rong-yi on Tuesday from the ECB Forum in Portugal. That's moderated by Bloomberg TV's Francine Lacroix. It's happening at 9:30 p.m. Hong Kong time. And we'll be speaking to U.S. Treasury Secretary Scott Bessent later today as the White House juggles looming deadlines on Trump's massive tax bill and tariff deals. You can catch that interview at the Times on your screen. As for Insight tomorrow, Schroders Group CEO Johanna Kirkland will be joining us with her investment outlook. That is it for Insight. Horizons Middle East and Africa is next. Keep it here with us. This is Bloomberg.